Okay, can I get your attention now? Yes. All right, I want 100% attention. Most important thing, uh, this standard is tested in every exam of you. Okay, this standard is tested in every exam of FR, and if it is tested for minimum 6 to 8 marks. 6 to 8 marks, it is definitely tested. Okay, so you go to the examination hall, and the standard, if you don't see it in your entire paper, what will you do? You go to the examination hall, you take the paper, you don't see IAS 12, income tax in any of your paper, what are you going to do, Shreya? You have applied for the wrong exam. Okay, it can't be a case where without IAS 12 there is a paper. So please stand up and come out of the examination hall. You will get IAS 12. Okay, IAS 12 is tested in every exam for FR. Okay, that is number one. Number two, it is a very complicated standard. Students get confused. Therefore, only if you give me attention throughout, you will understand the standard. If not, you're going to get confused. I will only explain it once, and I will never ever explain it ever again in your life. Okay? Okay, I'll explain it again also. But first time I want 100% attention. Okay? Everybody? Yes? Can we start? Yes. Guys online, can we start? Yes? Okay, onto your screen. Right. Forget about everything. I am going to look at an example directly. Okay, I'm not going to worry about anything. I'm going to take you through an example, and I want you to focus when I take you through the example. Okay, right. And this example has 4 requirements. Correct? The first requirement is calculate the annual tax expense. You are going to calculate the annual tax expense. Number 2, calculate the annual profit after tax. Number 3, calculate the annual deferred tax provision, and finally show the profit after tax with deferred tax provision. So how many requirement? 4 requirement, and I'm going to take you through this 4 requirement very slowly. Okay, I might need more time today because it's a complicated standard. All right. First, let's read the example together, right? JPLC started its operations on 1st of April 2019. On the same date, the company acquired fixed assets for 600,000. The company's policy is to depreciate assets at 25% per annum on costs. The company forecast a profit before tax of 500,000 for each of the next 4 years. So far, are you clear? Now, first thing that you need to understand is they're starting their operations on 1st of April 2019. They are purchasing fixed assets. Why do they need fixed assets? To run the company's operation, correct? 600,000. And you are depreciating. Obviously, your fixed assets are supposed to be depreciated in line with IAS 16. So, you are going to depreciate. And the company forecast a profit before tax of 500,000 for each of the next 4 years. So every year from this point onwards, they are looking at a profit before tax of 500,000. A profit before tax of 500,000. Are we clear? Let's go further. The company is liable to pay corporate taxes at 35%, and the tax authority allows a 50% capital allowance per annum on cost. But hold on. Before I come there, the very first thing that you need to understand is companies and individuals, you will have to pay taxes. A company will pay tax, and individual will also pay tax, correct? An individual will pay personal tax. A company will pay corporation tax. Excellent. Corp tax. Okay, clear? Right. Now, an individual will pay personal tax based on their personal earnings, and the company will pay corporation tax based on company's profits. Okay, so corporation tax is paid based on profits. So far we clear? Yes or no? Okay, now let's try to understand something very complicated, but I'm going to make it very easy for you, right? Now there is something called accounting profits. Accounting profits are based on accounting standards. Now, when we prepare financial statements, we apply accounting standards, correct? When we apply accounting standards, we get to accounting profits. Understood? Yes or no? Yes. But when the tax authorities, when you pay tax, you pay to the government, correct? When the tax authorities get tax from you, they don't base the taxes on accounting profits. They calculate something known as taxable profits. So when taxes are calculated, taxes are not calculated on accounting profits. Taxes are calculated on taxable profits. Taxable profits and accounting profits are two different concepts. I will explain the difference in a bit. But first thing to keep in mind is accounting profits and taxable profits are two different things. For the purpose of accounting, certain expenses can be allowed. For the purpose of taxes, certain expenses can be allowed. Allowed means deducted. Now, before going there, tell me, from a tax point of view, for the government, if the taxable profit, the taxes should be high for the government or low for the government? Government will want high taxes, correct? Correct? So if the government want high taxes, your profits before tax should be high and not low, correct? Your profit before tax should be high and not low. But what companies can do is, the companies can bring in artificial expenses where they can reduce the profit before tax, where if they reduce the profit before tax, your taxes will come down, correct? Yes, for that only the government has called something called taxable profit, where certain expenses are allowed, certain expenses are not allowed. The government says certain expenses I'm going to allow you, certain expenses I am not going to allow for you. So the allowable expenses are expenses that can be deducted for the purpose of taxes. Disallowable expenses are expenses that are not allowed to be deducted for the purpose of taxes. For example, if you have done your tax paper, anybody who has completed your tax paper? No, nobody. Okay, if you have completed your tax paper, in your tax paper there are a list of allowable and disallowable expenses. For example, penalty. Let's say there is a traffic penalty. Okay, you get a penalty from the traffic police. Let's get a traffic penalty. It's an expense for a business. No, for the purpose of accounting you can deduct, but for the purpose of taxes you can't deduct. So when calculating taxes, you will have to add it back. So the tax authority will add back. So certain expenses will be allowed, certain expenses will be disallowed. Am I clear? Am I clear? Notebook, first point, allowable expenses. First point. What is the first point? Notebook, first point, allowable expenses. Okay. Say, allowable expenses are expenses that can be allowed, that can be allowed for the purpose of calculating taxes. Next point, disallowable expenses. Disallowable expenses. These are expenses. These are expenses These are expenses which are disallowed, for the purpose of tax calculations. For example, motor traffic penalty. For example, motor traffic penalty. Motor traffic penalty. Traffic penalty. Okay. Leave a line. Therefore, the need to calculate taxable profits arises. Therefore, the need to calculate taxable profit arises. As accounting profits are calculated based on accounting concepts and standards. Therefore, the need to calculate taxable profits arises as accounting profits are calculated based on accounting concepts and standards. Did you understand that? Yes or no? Everybody understood that? No problem at all. Now, there is a difference between accounting profits and taxable profits. Yes, allowable expenses are expenses that you can deduct for the purpose of taxes. Now, any expenses that you incur wholly for a business can be deducted. For example, rent. Rent you are incurring to run the business, so you can deduct it for accounting purposes and tax purposes. But let's say motor traffic penalty. For accounting purposes, you can deduct it. For tax purposes, you can't deduct it because that is not a part of the business. Therefore, the tax authority says, look, you have deducted it. If you deduct something that is not a part of the business, that is going to bring down my taxes that you're going to pay me. So let's rework it. You add it back. Are we clear? Yes? Okay. So that means conceptually you understand accounting profits and taxable profits are two different things. Yes or no? Yes. But this is not tested for you in the exam. Your examiner is not going to come to you and ask you what are the allowable expenses and disallowable expenses. Your examiner is not going to ask you. Your examiner has something different to ask from you. I'll tell you what it is. Right? What will be tested is something that I'm going to talk to you now. Now, you know the difference between accounting and taxable profits, correct? Excellent. Let's go further.
What we have sections in this deduction under section?
Sorry?
Don't we have sections in this deduction under section 18 deduction?
I did not understand. Come again?
There is no section in this, like in income taxes, there are deduction under section 18.
You are talking about the tax regulations. No, you don't have anything like that. Nothing to worry. What is tested is only whatever is going to be affected as a part of taxes in the statement of financial position, in the financial statements. Okay? Right. Keep your pens down, focus. Now let's say, what's your name? Yeah. What did he say? Mega. Let's say Mega has a business. Okay? Let's say Mega has a business. Now Mega's business is, let's say, she's into air conditioners. She buys and sells air conditioners. Okay. And she has an operating profit before depreciation. Operating profit before depreciation of 500,000. Okay. And Mega has fixed assets worth, let's say, 10 million, for which she uses not 10 million, let's make it 1 million, for which she uses a depreciation rate of 25%. Okay, she depreciates her fixed assets based on 25%. So therefore what happens is her depreciation will be how much? Her depreciation will be 1 million into 25%, which is going to be 250,000. Correct? Therefore, she will have 250,000, let's say, profit before tax. Correct? Profit before tax. And let's say the tax percentage is 30%. Therefore, she is going to pay taxes of how much? 250,000 into 30%, which is going to be how much? 75,000. Therefore, her profits will be 250 minus 75, which is going to be 175,000. Correct? One scenario. On the other hand, you've got Shreya, who is also into the same business, whereas her operating profit before depreciation is also 500,000. No problem there. But Shreya has fixed assets worth 1 million, but you understand this 25% depreciation is an estimation or real value? Estimation. So Shreya's estimation and Mega's estimation, can it change? Yes, estimation is bound to change, correct? So she can say 25%, maybe she can say 15%, correct? Let's say Shreya says 10%. Shreya says 10% is her depreciation of her asset. Therefore, her depreciation cost would be how much? 100,000. So her depreciation will be 100,000, means her profit before tax will be how much? 400,000. Therefore, let's say her taxes is still at 30%. Taxes will be how much? 120,000. Therefore, her profit will be how much? 280,000. Now the thing to note here is both of them are in the same business. Both of them make the same profit. Both of them have the same asset base. However, Shreya is paying a higher tax than Mega. Correct? Correct? Fair or unfair? Fair or unfair? Fair or unfair? Unfair, because what can happen is Mega can overestimate the depreciation, make it higher, and reduce the tax that she pays today, this year. Next year also she can do that. But as she goes on in the future, the depreciation will balance because the value of the asset is the same now. In the future, Shreya will probably pay lesser depreciation and she'll pay higher depreciation. Why? Because the depreciation is over now. Correct. Because of the depreciation only, there is a difference in terms of the taxes. Correct. Yes or no? Yes. Therefore, Therefore, the government says, look, we don't want to be unfair. The tax authority says we are going to come up with a concept called capital allowances. Capital allowances means there is no depreciation, the concept of depreciation for the purpose of taxes. So both parties will not calculate depreciation, that is out. But the tax authority will say, for everyone out there, I am going to give you a fixed percentage. So you are not going to estimate, I give you a fixed percentage for the purpose of taxes, you are going to use that. So this problem of unfairness will be reconciled if Megha and Shreya has 30% standard capital allowance. Correct. So Shreya is going to apply 30%. Megha is also going to apply 30%. In that case, it's going to be the same for both. Then will there be a difference? No. Therefore, a concept called capital allowance is introduced, where there is no depreciation for the purpose of taxes only. However, there is a concept called capital allowance. Does that make sense? Does that make sense? Yes or no? Guys online, do you understand? Guys online, do you understand? Guys online, do you understand? Kind of. Okay, don't worry. I'll do a question with you. When I do a question with you, I'll explain it to you and you'll understand it better. Okay? Oh, Natasha, you're online today. Alright. I'm going to take you through very slowly, but so that you understand. Okay? I want you to focus. It's an interesting area. Okay, Omera, capital allowance means for the purpose of taxes, you don't have depreciation. You completely remove this depreciation, which is different figures, different estimations, and you come in a concept, bring in a concept called capital allowance, which is going to be a fixed percentage for everyone. Capital allowance is going to be a fixed percentage for everyone, so that everyone can deduct this capital allowance and get to their taxable profits. Capital allowance is calculated again based on depreciation. No, it is based on the asset, which I'm going to show you right away, Guru. I'm going to show you right away. Okay? Right. So now, I want you to read this question again on your own. Okay? Right. What is the first requirement? Calculate the annual tax expense. Right? Onto your screen. My first requirement is calculate annual tax expense. Do you understand so far? Do you understand? Okay. For me to calculate my annual tax expense, the first thing that I need to know is, when you take this question, for how many years does the company forecast its profits? 4 years. So therefore, I have my year 1, my year 2, my year 3, and my year 4. Okay? And then I have my profit before tax, correct? How much is my profit before tax? The company forecast a profit before tax of 500,000 every year. So 500,000, 500,000, 500,000, and then 500,000. Okay? Okay? When you calculated this profit before tax, would you have accounted for depreciation? Yes or no? Your profit before tax, after your profit before tax, what do you have? Tax, and after that you have profits, correct? So that profit before tax, will it include depreciation? Calculation of depreciation? Yes, already calculated. But is it correct? For the purpose of taxes, it's not correct. So I have to remove depreciation. So therefore, I'm going to remove depreciation. Correct? Alright. Now let's go back and understand how much is depreciation. How much is depreciation? They say 25% of what? On 600,000. Excellent. So 600,000 into 25% gives you how much? Sorry? 150,000. 150,000 should I add or deduct? Excellent. I have to add. There you go. Excellent. So I've added, correct? Yes. Instead, the tax authorities have given me another option to deduct, correct? What is the other option? Capital allowance. So I add this, I deduct capital allowance. Now if you go here, they say the company is liable to pay corporate taxes at 35%. The tax authority allows 50% capital allowance per annum on cost. So that means on cost for everyone it is 50% for Shreya, Mega, me, he, everyone. So that means I'm going to deduct capital allowance of 50%, correct? Alright. So my capital allowance, it's going to be how much? 600,000 into 50%. That's going to be first year 300,000, second year, third year. My total value of the asset is 600,000. First year I have claimed 300,000. Second year I have claimed 300,000. Third year will I claim anything? No, the asset is completely used, right? I don't have anything to claim here. I don't have anything to claim here. In other words, what I claim over a period of 4 years, I claim over a period of 2 years. What I claim over a period of 4 years, I claim over a period of 2 years. So I claim it today rather than claiming it tomorrow. So technically I could have claimed it over a period of time. But if I do it, there will be differences in terms of accounting, correct? That's the reason why I'm claiming it now. Therefore, this is something that is happening temporarily, no guys. This is not going to happen forever, correct? Some or the other, the asset will be used completely, no. So depreciation will be over, correct? So I'm doing it temporarily. Therefore, the difference that comes in the financial statements is known as a temporary difference. You will have a difference, no? That difference is known as a temporary difference. Clear? Right. Now, I can take my profits, correct? So how much is my profit? 500,000, taxable profit, 500,000 plus 150 minus 300 gives me 350,000. Over here, 350,000. Here, 650,000. Over here, 650,000. Correct? Correct? Okay. Now on this, I can calculate my taxes. Why? I have adjusted for depreciation and capital allowance. Now it's going to be equal for everyone, fair for everyone. So therefore, my taxes will be how much? At 35%. 350 into 35% gives me 122,500. 122,500. And then 227,500. 227,500. So I calculated my tax expense. So that's my requirement number 1. What's my requirement number 1? Calculate the annual tax expense. Done. Done. Did you understand? Everybody? So you understood? Are you sure? Are you very sure? 100% sure? I talk with you. Open your mouth and talk with you. Other time you talk a lot. I can't hear. Clearly? Okay, fine. That means all of you understood, right? Okay. Now I'm going to go further. So I'm done with my annual tax expense. What is my second requirement? Calculate the annual profit after tax. I have my tax. Now I have to calculate my profit after tax. Okay, excellent. So let me go further. Requirement 2. Calculate annual profit after tax. So once again, how many years? I have 4 years, correct? I have how many years? 4 years. So that means I have year 1, year 2, year 3, and year 4, correct? To calculate my profit after tax, first I need my profit before tax, correct? How much is my profit before tax? 500,000. That is only for the purpose of taxes I calculated, right? Now I'm going to present it in the financial statement. You understand? Now this is the presentation side. I'm going to take it to the financial statement. When I present, I have 500,000. I have 500,000. I have 500,000. I have 500,000. Correct? Correct? Okay. And from this, what do? I deduct my taxes, which I have already calculated. Correct? How much is my calculation? First year 122,500. Second year 122,500. Third year 227,500. Fourth year 227,500. Whatever I calculated. Correct? There you go. Here I calculated. No. Did I calculate? I'm taking these figures. Done? Now this I'm presenting in the financial statements. So when I'm presenting in the financial statement, that's what I get. And there you go. Now what do I get? I get my profit after tax. My profit after tax is going to be how much? 377,500. 377,500 to 272,500 and 272,500. That's presented in the financial statement. Type clear? That means, in other words, taxes, what is the percentage? I'm sorry, 35%. There you go. 35% taxes, 122,500. Correct? Clear? Everybody clear?
So in that DBT, the calculation of profit after tax, certainly we are considering depreciation also. We are considering depreciation.
Yes, depreciation will be on top. This will not come at all. The calculation, the tax calculation will not come at all. We are going to present whatever we have calculated.
Yeah, so in DBT, depreciation was considered.
Yes.
So if in a question, if they give in which the depreciation is not deducted,
They will never give like that. PBT means it's deducted, right? Clear? Clear? Okay. Then I have a question for you. Okay. Then I have a question for you. Guys online, everyone out there, I have a little question for you. Okay? Right. Now, what is your profession?
students,
Now, right now you're a student. You don't call yourself a student, you're a student accountant. You're a student accountant, right? You're not a student, you're a student accountant. And when you're done with ACCA, you're technically an accountant. Okay? You can call yourself as ACCA students, proud ACCA students. But you can only call yourself as proud ACCA students if you understand taxes. Correct? If you don't understand taxes, then it's a problem. Correct? Now, when is this financial statements presented to the shareholders? When do you present it? End of the year means 31st December, end means 31st December itself you present? No. In the AGM, there you go, Aditya, you are the person, okay. Aditya says, you present the financial statements to the shareholders in the AGM. What is AGM? Annual General Meeting. What happens in the AGM? all your shareholders come together, and you give the financial statements, correct? And all of you who are accountants have prepared the financial statements. You're going to present it to whom? Shareholders, correct? What is your profession, by the way? Current accountant. You'll be an accountant, right? So, yeah, there you go. Now, let's say you're in an AGM, a massive AGM. Massive AGM. Massive AGM. How big? Like Reliance. There you go. Superb. Who gave me that example? Excellent. Reliance. Like what Dhirubhai Ambani did. Do you know Dhirubhai Ambani? I told you, right? Dhirubhai Ambani is the father of Mukesh and Anil Ambani. And if you watch this movie Guru, you watch this movie Guru? No? No one has watched the movie Guru? No? Okay. You missed a long, you missed something very exciting in your life. You've missed Aishwarya Rai. You know, Aishwarya Rai, haven't you heard this song? Aruire yenne mannipaya, no? Aruire yenne mannipaya song, no? You heard, right? There you go. That song comes from Guru movie. In that movie, Aishwarya Rai. Hey, Aishwarya Rai, right? Yeah, there you go. Have you watched the movie? No? Okay, hold on. If you watch that movie, at the end of the movie, there'll be an AGM, an annual general meeting. At the end of the movie, there'll be an AGM. You know where will the AGM be? You know where the AGM will be? I'll show you where. Hold on. No. There you're right. You just said. Where will it be?
Stadium.
What stadium? It's a football stadium. Guys, look here. I can go on YouTube, right? Now look here. Something very interesting, okay? Guru movie climax. Tamil or Telugu or Malayalam? Okay, Tamil comes first. Okay, there you go. Now, you can see my screen, right? I don't think there's sound. No, not that. Okay, there you go. This is the AGM. No volume. You don't need that. This is the AGM. And this AGM happens where? In a football stadium, an AGM is happening. Okay? Where's that? Wait, let me show you properly. Why doesn't this come? So you're getting a lot of There you go. This part, okay? I have only one question from you. Look here. I have only one question from you. Right? You are presenting these financial statements in the AGM to the shareholders. And you can have how many shareholders? 100,000, 5,000, 10,000, 50,000 shareholders you can have. Yes? One shareholder raises his hand. Shreya, what does he do? Raises his hand and he says, "Hey Shreya, you've done an excellent job in terms of the financial statements. You've done an excellent job in terms of the financial statements, but I have only one doubt. Can you please clarify?" Yes? So what did he say? Yes, please. Okay, fine. The shareholder, you know what he'll do? He'll take the calculator. Can I get the calculator, please? Okay. The shareholder is going to get the calculator, right? And he's going to enter only one thing. How much is the profit before tax? 500,000, correct? How much is the taxes? 35% into 0.35. How much do you get? 135,000. Huh? What did you say? What did you say? 100 into 1,500. But how much are you getting? 175,000. Ah, there can be a problem with this calculator. We'll use another calculator. No. Maybe you will separate differently. Okay, we'll use another calculator. 500,000 into 0.35. 175,000. This calculator is correct. So, Shreya, what are you going to tell the shareholders? Okay, fine. Let's forgive her for that. Okay, fine, let's forgive her for that. 500,000, 35%, 122,500. 500,000, second year, 35%, 122,500. Third year, 500,000. 35%, you're taken 227,500. What has happened? Now the shareholder, hold on. The shareholder is going to ask you this question, and what are you going to do, Shreya? Well, you're going to tell the shareholder, hey, shareholder, shh. Hey, well, this particular adjustment, when I learned, Rian told me it's a bit complicated. Baga is not in the country. He went to Sri Lanka. I can't contact him. I don't have any number. Well, just forgive me only for that. That's okay. You're gonna talk to the shareholder like that? Yes or no? No. For this particular adjustment, I actually don't know. Are you gonna tell something like that? Yes or no? What is our profession? What is our profession? We are an accountant. Hold on. What does our accounting profession say? Hold on. A month ago, I went to a doctor, right? I was not feeling well. I went to a doctor. Doctor gave me a prescription, okay? It was a funny prescription, right? You know, you get doctor's prescription, right? So, 1, 2, 3, 4. I was not feeling well. I took this prescription. I went to the pharmacy. I showed the prescription. Doctor's handwriting, normally, can you read? No. I went to the pharmacy. I gave this prescription. She gave me only 3 medicines. How many medicines? I was a bit confused. Maybe I don't know the medicines, but I know the numbers 1, 2, 3, 4. So I went to this pharmacist and I said, ma'am, I think there are 4 medicines here. You give me only 3. Can I get one that is missing? You know, she told me, sir, that's your name, sir. Hold on. My question is very simple. Will you ever go and question the doctor when doctor gives you a medicine? Have you ever questioned the doctor? No, you will never question the doctor. The lawyer's profession, he gives you an advice. Will you ever question the lawyer? No, but our profession is the only profession that speaks about understandability, and in an AGM, you can be questioned. Correct? That's our profession. Our profession, in terms of characteristics, qualitative characteristics, it speaks about what? Understandability. Financial statements should be understandable. And if you present financial statements like this, is it understandable or not understandable? Not understandable. So there is the problem. Correct? There is a problem. What is the problem? The first problem is, why does the company never pays taxes at 35%? Correct? The company is not paying taxes at 35% because the value is different. Correct? That's the first problem. The second problem is, why does the company pays different amounts for taxes for the same profit same profit and tax rate. You have two problems. First problem is, why does the company never pay taxes at 35%? The second problem is, well, you are paying for the same profit, same tax rate, different amount of taxes. Correct. So if I reconcile these two problems, we are sorted with income taxes. Correct? So Shreya, all this while, did you understand all what I was talking to you? You understood? Yes. Okay, fine. That's where a concept called deferred tax comes in. So next what we have is to learn something called deferred tax, and that's what I'll be teaching you. Before that, I want you to copy this. Put a line, leave a line and say, with the above, with the above, with the above, with the above, the readers will have the below confusions. The readers will have the below confusions. First confusion, number one. Why does the company, first confusion, why does the company never pays taxes? Why does the company never pays taxes at 35%? At 35%. Why does the company never pays taxes at 35%? Second confusion. Why does the company pay different amounts of taxes for the same profits and tax rates? For the same profits and tax rates. Okay, right. Now we are going to see how to reconcile the problem. Okay, right. Subheading deferred tax. 1F 2R, deferred tax. Okay, right guys, this is the most trickiest part. I want you to focus. The most trickiest part is this. Okay, you got to focus. Right. Now if I tell you that depreciation is allowed for the purpose of accounting profits, you have to agree with me, because depreciation can be deducted for the purpose of accounting profits. So I can call it accounting written down value, meaning this can be reduced, allowed for accounting purposes. When it is allowed for accounting purposes, you call it accounting written down value. However, it is disallowed for tax purposes. What is allowed for tax purposes is capital allowance, correct?
Yes.
So can I call it tax written down value? Now basically we have this confusion because of the differences that have between accounting written down value and tax written down value. If there is no tax written down value, we don't have this confusion, correct? So this accounting written down value and tax written down value creates a confusion. To reconcile this confusion, we study something called deferred tax. A deferred tax is a tax that is created as a provision. It is a provision that we create. The provision that we create, one or the other, it will in the future reconcile, correct? Because your taxes will, your depreciation will be used, or your capital allowance will be used in the future. So it will use in the future. No. So what we do is we put up a temporary account called deferred tax account to solve the problem. Therefore, carried forward deferred tax equals accounting written down value minus tax written down value into tax percentage. Because the difference comes because of the difference between accounting written down value and tax written down value and the tax percentage. Therefore, we are going to study a concept called deferred tax, which is going to make the financial statements understandable. The purpose of deferred tax is to make the financial statements understandable. And what I will do is, by applying this deferred tax provision, I will show you that the financial statements are understandable. We don't have the confusion. Can I show you? Yes. Right. Keep your pens down. I want 100% focus. Okay. Hold on. When I explain, you'll understand. And after that, let me explain throughout. Until then, listen to me. And after I explain, if you have any doubts, ask from me. Because your doubt now can be something that I'm going to explain in about 2 or 3 minutes. So I will go with the flow. Listen to me very carefully. And if you have any doubts, you can ask all your doubts. Not a problem. Okay. But I want 100% attention. All right. Like I told you, what is the purpose of deferred tax? Deferred tax is going to make tax understandable, correct? And therefore, we have a formula which we just studied, that is carried forward deferred tax equals accounting written down value minus tax written down value into tax percentage. I'm going to prove it now. Okay. Right. Look here. Now, that's where my third requirement comes in. What is the third requirement? Calculate the annual tax expense, deferred tax expense. So I'm going to calculate number 3, annual deferred tax expense. Right. Now what happens is, I have an asset which has a carrying value, an accounting cost value of 600,000, correct? When I started in my year, my cost, and in terms of accounting written down value and tax written down value, I have the asset, correct? Now the cost of the asset is 600,000 here, and over here it is going to be 600,000. I have depreciation for the purpose of accounting, capital allowance for the purpose of taxes. My depreciation for year 1 for the purpose of accounting is going to be how much? 150,000. For the purpose of taxes will be 300,000. Clear? This 150,000 and 300,000 is the primary reason why I am doing the calculation, correct? So therefore, as at the year 1 end, I will have 450,000 as my accounting written down value, and I will have 300,000 as my tax written down value. In other words, my accumulated depreciation is high. Sorry, my capital allowance is higher than my depreciation. But some or the other, one day it will reconcile, correct? Excellent. The difference between my accounting written down value and tax written down value over here creates an accounting provision called deferred tax. What is the difference? 150,000. What is the tax percentage? 35%. Please take your calculators. 150,000 into 35% gives you how much? 52,500. Okay, this is in the first year. This is in the first year. The standard requires us to put a deferred tax account. So what we are going to do is we're going to come right below. We are going to put up a long account by the name deferred tax. This deferred tax account will be there until we use the depreciation and capital allowance, until we completely use. Until that point, there will be deferred tax. So how much is the carried forward deferred tax I have? 52,500. So I'm going to take my 52,500 and technically set it off against my income tax liability, income tax account. I have 4 years, no, 4 income tax account I will have to put up. So my first income tax account will look like this. Tax year 1. My second year will look like this. Income tax year 2. And then I will have my third income tax year 3. Stop talking. And my final income tax year 4. That is my income tax account. Every year, whatever the taxes that I take to the P&L will be based upon this. Okay. But deferred tax is going to be a temporary account until my assets, depreciation and capital allowance are completely used. So what is going to happen is the double entry to account for depreciation will be I credit deferred tax. It's a provision, right? I credit my deferred tax saying income tax, how much? 52,500. And I debit my income tax account saying 52,500. My first year. Are we clear? Yes? Yes or no? Okay. However, what happens is in the current year, in this income tax account, I should also make my tax payment, cash paid. How much is my cash paid? My cash paid is exactly, who told me, who gave me that figure? Who gave me that figure? Excellent. My cash paid was 122,500, which I have on top. There you go. My taxes that I paid. 122,500 means, excellent Aditya, I credit my cash, I debit my income tax account. So I debit this account saying cash 122,500. Therefore, my total will be 175,000. 175,000 to my P&L first year I will take 175,000. That's it. Did you understand that? That only, nothing else. Okay, my first year is over. My deferred tax is 52,500. Carried forward 52,500. Why? I'll have 52,500 here, 52,500 here, and I will have brought forward 52,500. Correct? And 1 year has gone by. I come to the top. My 1 year is just over. So now I have to do it for my second year. My second year, once again, I will have depreciation and capital allowance. Correct? My second year, depreciation will be 150,000. My capital allowance will be 300,000. Excellent. So my 450 minus 150 will be how much? My 450 minus 150 will give me 300,000. And this will be 0. Therefore, my accounting written down value and tax written down value, if I deduct, I will have 300,000 into 35%. That gives me a tax rate, deferred tax of how much? 105,000. Like I told you, deferred tax is a continuing account. Okay. I already have 52,500, but this year my deferred tax have gone up to 105,000. Meaning my carried forward is now 105,000. correct? If my carried forward is 105,000, 105,000, 105,000, I have a difference 52,500. Where do I take it? To my income tax account. Second year, excellent Aditya, well done. Good job. So I come to my income tax second year, right? I will have deferred tax of how much? 52,500. And second year I have to pay cash, correct? How much is the cash paid? 122,500. There you go, 122,500. I'll take it over here. So my second year total will be 175,000. 175,000 to my P&L. How much do I take? 175,000. Excellent, second year done. I'm done with my second year. I move forward to do my third year. Okay. Now when I come to my third year, once again I have depreciation and capital allowance, correct? How much is my depreciation? 150,000. Excellent, making this 150,000, correct? This becomes 0. 0 minus 0 is 0. 150,000 minus 0 gives you 150,000 into 35%. That gives me 52,500. In other words, my deferred tax from 52,500 went up to 105, but now it has come down to 52,500. If it has come down to 52,500, once again, I have my carried forward figure 52,500, correct? Right. So now what I'm going to do is, I'm going to take my total. Yeah, I got brought forward. Wait. I don't have space. Just I don't have space. So guys, I'm going to just clear this off and then going to work around it. Okay. Okay. Guys, look here. I have brought forward 105,000, correct? And I will have carried forward of how much? 52,500, correct. I've got my space now. So 105,000. This time I have a difference, but on my debit side. Yes, I have a difference on my debit side. Where do I take it once again? To my income tax account. That will not change. Always to my income tax account. That will not change. How much is the difference? 52,500. If I forget, I'll take my brought forward as well. 52,500. Okay, excellent. Now I will move on to my third year income tax account, correct? My third year income tax account, year 3, will have 52,500, but this time a debit or credit entry. Excellent, well done. I debited my deferred tax. I will credit my income tax account. So what I'm going to do is I'll come here. I'll say 52,500. My third year, how much am I paying as cash? 2 I credit cash, debit this account, 227,500, 227,500, 227,500. Therefore, to my P&L, how much will I take? 175,000. Okay, and then I move on to my last year, where now I have my deferred tax account that I have to do again, where this is year 3 and now I have my year 4. I have depreciation and capital allowance, correct? Last year, how much is my depreciation? 150,000, meaning technically my depreciation is also over, my capital allowance is over. If both of them are over, my deferred tax should be my last year, correct? I shouldn't have anything there. So my 150 minus 150 gives me 0. Over here, 0 minus 0 is 0. 0 into 35% gives me 0. Correct? Okay, now I come back to my deferred tax. I brought forward 52,500. Yes. Carried forward, do I have anything? Carried forward, do I have anything, everyone? Yes or no? Are you sure? Yes, brought forward I have 52,500. So therefore, I don't have anything there. So 52,500, 52,500. I will have a difference. Where should I take the difference? 52,500. I debit this account. I come to my income tax account. I put up my fourth year income tax year 3. I debit that account and year 4. I'm so sorry. I'm not good with figures. But all of you need to be good with figures. Figures are very important, Aditya. In life, without figures, you can't do anything. Okay? Anyway, I debit my deferred tax account and I will credit my income tax account, correct? So I'm going to say deferred tax 52,500. My last year, how much am I going to pay? 227,500. Credit cash, debit this account. 227,500, correct? So 227,500, 227,500 to my PNL. I'll take 200. Excellent. 175,000 year 4. Hold on, I'm not done yet. Now, going back, calculate annual deferred tax provision. Did we calculate? Yes, we just calculated. And finally, show the profit after tax with deferred tax provision. So, my last requirement is profit after tax with deferred tax, correct? That's a requirement, right? With deferred tax. All right. How many years? Once again, 4 years. So year 1, year 2, year 3, and year 4. Share how much in the profit before tax? 500,000. 500,000. 500,000. And then 500,000. What's my taxes percentage? 35%. Okay, if I calculate by 35%, first year how much do I get? Year 1 how much? Year 1 PNL how much? Year 2 how much? Year 3 how much? Year 4 how much? Now take your calculators. 500,000 into 35%, 175. 500,000 into 35%, 175. 500,000 into 35%, 175. And also last year, you will get 175. Correct? So 500,000 minus 175 gives you 325,000. 325,000. 325,000. And finally 325,000. That's your profit after tax with deferred tax. Hold on. What was our confusion? Confusion was why the company never pays taxes at 35%. Does the company now pay taxes at 35%? Yes. Second confusion, why does the company pay different amount of taxes for the same tax rate? Now, is that the problem? No, that's not a concern anymore. How? Because deferred tax was able to solve us the problem. You understand? Yes, do you understand? Hold on, do you understand? Okay, can I tell you a good news? You will never be tested with a calculation like this in the exam. You will never ever get a question like this in the exam. It has never been tested in the exam to this depth. Never ever tested. Exactly. That's a very good question. Sir, do you have a pain for you to take about 1.5 to 2 hours time and take us through the entire concept? Now, if I have come and told you that deferred tax is the difference between accounting written down value and tax written down value and shown you a shortcut to get the answer, you would have taken. But you wouldn't understand the logic behind what we are studying. It's not only about passing the exam, it's about understanding the logic. You need to know why we are studying, not just what we are studying. You understand?
Yes, sir.
Not just what we are studying, there's a reason, there's a logic behind the standard, and you need to understand why the standards came up. And if you don't know the logic, you're going to get stuck in your life. Correct? That's why I had to take this 1.5 to 2 hours to show you how the standard came in, the problems with the standard. Because, Shreya, look, guys, these standards are a solution to a problem. Correct? IASB, International Accounting Standards Board, comes up with these standards as a solution to the problem. So if you understand the problem, the solution becomes easier. That's the reason why I had to take you through the problem. Now that you know the problem, you understand why we calculate deferred tax. It's not tested like this. It has never been tested in the exam to this extent. I will exactly tell you how to calculate deferred tax within about 3 to 4 steps. I'll give you steps, you apply the steps, you get the answer. But you understand the logic, the flow behind it. Yes? Understood? Copy it. So in the financial statements, will there be a deferred tax or tax liability? Monish, there will be both a deferred tax liability and a tax liability. If there is a tax liability to be paid. Please copy it. Okay. Heading. Heading exam shortcut. Exam shortcut. Exam shortcut. Step number 1. Step number 1. Guess this. Step number 1. Step number 1. Draw 3 T accounts. Draw 3 T accounts. Three T accounts. Okay. First account, income tax account. First account, number 1, income tax. Number 2, tax payable account. Number 3, number 2, tax payable. Number 3, deferred tax account. Deferred tax account. Okay. Draw 3 T accounts. Income tax account, tax payable account, deferred tax account. Okay. Step number 2. Step number 2. Take the brought forward figures. Take the brought forward figures. Step number 2. Take the brought forward figures from the trial balance. From the trial balance. From the trial balance. Step 2, done. Step 3. Account for the current year tax. 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 Step number 3. Step number 4. Step number 4. Account for deferred tax using the below formula. Account for deferred tax using the below formula. So carried forward deferred tax equals accounting written down value minus tax written down value into tax percentage. That was step number 4. Step number 5, most important step. Most important step, step number 5. Most important step, step number 5. Always trust Zian. I'm serious, take it, okay? I'm not joking, take it, okay? Take it. Very important point. You need to always trust me. You can't think. Does he know what it is? Does he know what he's talking about? You need to know that, okay? Always trust Zian, okay? Take that. That is very important. Most important step. Okay? Took? Okay, let's look at a question. Requirement is show the required entries for the current year. Okay? Black Nose PLC has estimated its income tax liability for the current year to be 115,000. The corporate taxes are paid at 25% and the brought forward deferred tax was 585,000 at the beginning of the year. By the year end, the accounting written down value of the company's asset base has exceeded the tax written down value by 2,520,000. Don't worry about anything. Just go to my steps. What is my first step? Okay. Look here. My first year account, my second year account, my third year account. What is the name of my first year account? Income tax account. Second year account? Tax payable account. Deferred tax account. Okay. First step done. Hold on. First step done. What is the second step? Okay. Trial balance is not there, but in this case, you have these notes. Go to the notes. What are the brought forward figure that they have given? What is the brought forward figure? For what? 585, 500 for? Deferred tax. Debit or credit side deferred tax? Always credit. It's a provision, right? So brought forward 585, 500. That's it. What did I say next? Next step. Share. Without copying. Look here. What is the second step? Account for the current year tax. How much is the current year tax that they estimate? 115,000. How to account for current year tax? Debit taxes, credit tax liability. Correct. Debit your income tax, credit your tax liability. So that is tax liability means tax payable. How much is it? 115,000. Debit income tax, credit tax payable, saying income tax 115,000. Was that difficult? No. What is my next step? Account for deferred tax using the formula. What is the formula? Accounting written down value minus tax written down value into tax percentage. Now, have they given you the accounting written down value? No. Have they given you the tax written down value? No. But they say by the year end, the accounting written down value of the company's asset base has exceeded the tax written down value by 2,520,000. In other words, they have done the deduction already for you. So even that is made simpler for you. Guys, look here. That is made even simpler for you. They have already deducted it for you. So that means this particular carried forward is there, no? Accounting written down value minus tax written down value. The difference is already given. What's the difference? 2,520,000. It's already given. So are you going to do anything? No, but into percentage. What is the tax percentage? 25%. 2,520,000, 25% gives you. Carry it forward. 63,125,000. Is that correct? Guys, do the calculations properly and tell me. $2,520,000. Oh, that's wrong. Okay. What I've taken here is wrong. $2,520,000, correct? Into 25% gives you 60. Tell me the whole figure. How much? 63. $630,000. 630,000. 630,000. Yes? You can say 630,000 or 6,30,000. Okay, 630,000. So 630,000. 630,000. You have a difference. How much? How much is the difference?
165.
No, it can't be the case. No, can't be the case. Sorry? 44,500. Where do I take 44,500? To my income tax account, correct? Difference, deferred tax, remember? I took it to income tax account. So I have a credit here means I have a debit here. Deferred tax, 44,500, correct? 115,000 plus 44,500 gives me 159,500. 159,500. To my PNL, I'll take 159,500. To my balance sheet, I'll take 115,000. 115,000. I have a liability to pay 115,000. This will go to my balance sheet, tax payable liability. And I have a deferred tax liability to my balance sheet, statement of financial position. I'll take this. 2 marks. 2 marks. 2 marks. In the exam, you get 6 marks. Balance sheet. Balance sheet means 100 and where? Clear? All right. Let's take the break. After break, let's do past papers.